Investing can be a great way to grow your wealth and achieve your financial goals. However, with so many investment options available, it can be challenging to know where to start. One common question that many investors have is how to achieve a 10% annual return on their investments. In this article, we will discuss 5 simple steps to help you achieve this goal. I want you to stop and like this video. Also subscribe for more videos. Don't forget to check the descriptions for more inspiring videos. Step 1. Set a realistic investment goal. Before you start investing, it is important to set a realistic investment goal. This means considering your current financial situation, your investment experience, and the amount of money you are willing to invest. It is important to note that higher returns often come with higher risk. If you are new to investing, you may want to start with a more conservative approach. Your investment goals should be specific, measurable, attainable, relevant, and time-bound. For example, you may want to aim to earn a 10% annual return on your investments over the next 5 years. By setting a specific goal, you will have a clear target to work towards. Step 2. Diversify your investments. Diversification is key to minimizing risk in your investment portfolio. By investing in a variety of assets, such as stocks, bonds, real estate, and mutual funds, you can spread your risk and potentially earn higher returns. It is important to allocate your investments based on your risk tolerance and investment goals. Diversification also helps to reduce the impact of market volatility on your portfolio. For example, if one asset class is performing poorly, other asset classes may be performing well, which can help to balance out your portfolio. Step 3. Invest in low-cost index funds. One of the easiest and most effective ways to earn a solid return on your investment is to invest in low-cost index funds. These funds track a market index, such as the S&P 500, and offer broad exposure to a variety of companies. Index funds are low-cost because they require less management than actively managed funds, which means more of your money goes towards investments. Index funds are a great option for investors who want to achieve long-term growth. They provide broad market exposure, which helps to reduce the impact of individual company performance on your portfolio. They also have lower expense ratios than actively managed funds, which means more of your money is invested. Step 4. Rebalance your portfolio regularly. Rebalancing your portfolio is an important step to ensure that your investments remain aligned with your investment goals and risk tolerance. Rebalancing involves selling off overperforming assets and buying underperforming assets to maintain your desired asset allocation. This helps you avoid investing too much in one asset class and reduces your risk. Rebalancing your portfolio also helps to reduce the impact of market volatility on your investments. For example, if the stock market is performing well, your stock investments may increase in value, and you may need to sell some of them to maintain your desired asset allocation. Step 5. Invest for the long term. Investing for the long term is essential if you want to achieve a 10% annual return or more. By holding your investments for at least 5 years, you can ride out market volatility and potentially earn higher returns. Remember, investing is a marathon, not a sprint. Investing for the long term also helps to reduce the impact of emotional decisions on your investments. For example, if the stock market experiences a sudden dip, it can be tempting to sell off your investments to avoid further losses. However, by holding your investments for the long term, you can avoid making hasty decisions based on short-term market fluctuations. Achieving a 10% annual return on your investments is possible with the right knowledge and strategies. By setting realistic investment goals, diversifying your investments, investing conservative approaches, and investing in low-cost index funds, you can potentially earn solid returns. Rebalancing your portfolio regularly and investing for the long term are also important steps to help you achieve your investment goals. It is important to note that investing always carries some level of risk, and there is no guarantee of returns. However, by following these 5 steps, you can minimize your risk and potentially earn higher returns over the long term. Another important factor to consider when investing is your own risk tolerance. Everyone has a different level of comfort with risk, and it is important to invest in a way that aligns with your personal values and goals. If you are new to investing or have a low risk tolerance, it may be helpful to seek the advice of a financial advisor to help you build a portfolio that meets your needs. Investing for a 10% annual return requires a combination of patience, knowledge, and strategy. By setting realistic goals, diversifying your investments, investing in low-cost index funds, rebalancing your portfolio regularly, and investing for the long term, you can potentially achieve solid returns over time. Remember to always consider your own risk tolerance and seek professional advice if needed. Wait a minute. Like this video and subscribe. Step 6 title: Preparing a Successful Investment Journey. Investing is a journey that requires time, patience, and practice. To embark on this journey, investors need a plan and a time frame to achieve their investment goals. Investors should begin by defining their destination and then developing an investment strategy accordingly. For instance, investors looking to retire in 20 years must ask themselves how much money they will need to retire comfortably. Once a plan is in place, investors must learn about how the market works, which includes reading books, taking investment courses, and learning modern financial ideas. This combination of science and art in finance is vital to creating simple investment rules that work best for each individual. Investors must also identify their personality traits, such as whether they are careful or impetuous, confident or anxious. This will help them manage their behavior while investing. Beware of false friends who may conflict with your interests, such as unscrupulous investment professionals. The best investment results tend to be realized by individuals who exhibit analytical behavior and confidence, and have a good eye for value. However, investors should manage their core assets systematically and discipline, regardless of their personality type. Investors should also understand that they are potentially their own worst enemy, and should identify and modify the factors that may prevent them from investing successfully. To find the right investing path, investors must consider their level of knowledge, personality, and resources. Diversification is key in low-risk diversified portfolios that allow investors to learn by doing. Gradually, as they gain more knowledge, investors become better suited to take a more active stance in their portfolios. Online brokers offer a variety of tools that can help investors of all levels to achieve their investment goals. By following these 7 steps, investors can create a successful investment journey that will provide them with the financial security they desire. Keep a long-term mindset. It's important to remember that investing is a long-term journey, and success is not achieved overnight. It's easy to get caught up in short-term fluctuations and market noise, but these can distract you from your long-term goals. Instead, focus on your investment plan and stick to it. Review your plan periodically and make adjustments as needed, but don't make drastic changes based on short-term events. Learn from your mistakes. No one is perfect, and mistakes are a natural part of the learning process. As you progress on your investment journey, you will likely encounter setbacks and make some wrong moves. However, the key is to learn from these mistakes and adjust your approach accordingly. Don't let fear or frustration get in the way of your progress. Instead, use these experiences as opportunities to learn and grow. Investing can be a daunting task for many people, but with the right mindset and approach, it can be a rewarding journey. Here are some additional tips to help you on your investment journey. Start small and build your portfolio over time. It's important to start small when you're first starting out in investing. Instead of investing a large sum of money all at once, consider starting with a smaller amount and building your portfolio over time. This allows you to learn about the market and develop your investment strategy without risking too much money upfront. As you become more comfortable with investing, you can gradually increase the size of your portfolio. This will allow you to take on more risk and potentially earn higher returns over time. Diversify your portfolio. One of the most important principles of investing is diversification. This means spreading your investments across different asset classes, such as stocks, bonds, and real estate. Diversification helps to reduce your overall risk and protect your portfolio from market volatility. When diversifying your portfolio, it's important to consider your investment goals, risk tolerance, and time horizon. For example, if you have a long-term investment horizon, you may want to consider investing in growth-oriented stocks, while if you have a shorter time horizon, you may want to focus on more conservative investments, such as bonds or cash. Keep an eye on fees. Investing can come with fees, such as management fees and transaction costs. While these fees may seem small, they can add up over time and eat into your investment returns. Before investing in any fund or product, be sure to review the fees associated with it. Look for low-cost options that offer competitive returns. Online brokers often have lower fees compared to traditional brokers, making them a good option for many investors. Stay up to date on market trends. The financial markets are constantly changing, and it's important to stay up to date on the latest trends and news. Follow financial news outlets and industry experts to stay informed about market developments and potential investment opportunities.